Mark, part of the estate planning process, and especially splitting assets, everyone, if you have three kids, it's you always hear it's a third, a third, a third. And some assets are easy to value, like your bank account. You know exactly how much it's worth. Your house, you don't know exactly how much, but you can get pretty darn close. For a lot of our business owners, what's the business actually worth? Not only varies day to day, year to year, but it depends on a lot of different things. And does that person own 10%, 20%, 100%? What percentage ownership also varies with the actual value. So the reason I'm bringing this up, when coming down to the how do we split assets, how frequent and what do you recommend people do when it comes to an asset like a business that's hard to actually value when they're splitting up an estate?
Yeah, I think that can depend on whether a couple of factors. One, whether they have a child that's involved in the business,
Yeah.
which we see that quite frequently, and coming up with a way to value it so that, of course, it's fair for the other family members, but is there a way to potentially even do some gifting of that business now to the child? So, so it can depend on the circumstances. When we're talking about estate planning from a gifting perspective and estate tax perspective, the valuation becomes a little more important because you can't just pull a number out of thin air for the IRS or the Department of Revenue. And so that in that case, more formal valuations become a vital part of the plan. If you're doing the gifting ahead of time, there's what are called freeze techniques, so that if you can get your business valued at a lower number and gift that to your kids, preferably in trust, not outright. But now it's considered outside of your taxable estate at that lower value. And then at the time you die, if that value of the business has increased, all that appreciation is considered to have happened outside your taxable estate and would go estate tax free to the children. So in that circumstance, you want to be very careful about professional valuations.
And then how do you deal with, you have, again, going back to our three kids, you have one in, one halfway in, maybe one out. How do people equalize estates when we're talking about a business interest?
Yeah. Sometimes it's a matter of dividing up the accounts. If you're able to look at it and say there's enough other value and equal value in my other assets, so I'm going to shift and allocate those more heavily towards the child that's not involved in the business. If that's not the case, you'd have to look at some, I think, financial planning options in that case, and maybe even insurance options to try to provide a way to supplement what the child who's getting the business versus those who isn't. So if you have some extra funds that you can pass on to those who aren't getting the value of the company.
Yeah, and a lot of relationships are based on communication, right, Mark? We have great communication, of course, but communication in the next generation. And we've seen businesses actually get purchased by the next generation. So you have, back to our three kids, you have two children in the business. They actually are purchasing it from mom and dad, and they have another sibling that they weren't a part of the transaction. They actually, one assumed it was gifted, but the one that is actually in it is actually purchasing it. How would you recommend, and when would you recommend in the estate planning context, communicating that actual transaction to someone to assume the person left out doesn't assume that they're getting their third of the business at the point of demise of their parents?
So how would you, so the question is, how would you communicate to the beneficiary who's not receiving the business?
Yes. When there was an actual transaction, right? There was the two people in the business actually purchased it for a relatively speaking fair market value, because we've seen that, and you've seen it too. Some business owners, their entire net worth, they sit in it every day. It is actually their business. So for them to literally gift it to the next generation is impossible unless they want to impoverish themselves, which, by the way, Financial Planning 101, I wouldn't recommend. So you have to actually have a transaction there. And if you're not a part of the transaction, you don't know the details. And usually the estate attorney and the financial planner and the business attorney are working together on that one, because you don't always sell for fair market value. There's usually a little family discount in there, because there can be. Hopefully they can afford to be. So how do you see, and when do you see people actually transition that, or excuse me, have that communication to make sure the person left out of the transaction is actually brought up to speed?
Yeah, I would say documentation is important. So just documenting your steps, whether it's in the form of here's how we obtained the valuation, copies of that. you have a promissory note or some type of document that shows what the payment stream is and has been over the years back to the owner, the parent of the company. And, again, a family meeting, sitting everyone down. I think communication is important. Like you said earlier, just having the communication between your financial and CPAs and attorneys is important, but so is it important among family members so that there really aren't surprises later on.
So you're telling me handshake agreements are not going to work here?
Handshake agreements, back of the napkin, back of the no, those don't work.
Yeah, we see it go awry so many times, don't we?